Hello everyone, welcome to Real Talk Investing. I want to thank each of you for tuning in to today's video. Today we are going to cover a topic that I am really excited to get into. First off though, as we all know, the stock market right now is a crazy place. We are seeing a full-blown correction unfold before our eyes. Today, the S&P 500 is down about 1.6% and is down a little over 4% in the last 5 days. We also have popular stocks such as Tesla that are down over 20% in the last 5 days and down over 30% in the last month. So with all of this going on, it seems like this is all everyone is talking about. And as fun as it is to talk about losing a ton of money, today I'm going to cover something a little bit different. Before we get into today's topic, I do want to say that I am a buyer in this market. As you can see, we have entered extreme fear on the fear and greed index. Now, we all know the popular saying, be greedy when others are fearful and be fearful when others are greedy. So we are now reaching peak fear, and we all know that that is a great time to start picking up shares in great companies. So for me personally, I have been dollar cost averaging into some great companies that have been hit very hard over the last month, such as AMD, Celsius, and I've actually picked up some HIMs after they reported earnings and dropped quite a bit. So I believe now is a great time to be a buyer in this market. It could get worse, so that is why I am utilizing a DCA, dollar cost average strategy right now in this market. So that's the last that I want to talk about the stock market and what's going on right now. Today I want to talk about something a little bit different, and that is how much money do you actually need invested to live off of your dividends? Now, I'm sure this is something that we have all thought about at some point or another. I know that I usually think about this when I'm sitting in traffic on my commute to my day job, hating life. I'll sit there crunching numbers and thinking about how much money do I actually need to accumulate in order to put into either a high paying dividend stock or dividend ETF to quit my day job and just live off of the passive income that I would receive through dividends. So let's get right into that. Starting out, how much money do you actually need? Now, unfortunately, there's no cut and dry answer here, as this is going to be different for everyone. Everyone listening to this video is going to be a different age, be in a different income class, live a different lifestyle. You know, the list goes on and on and on. So there's no cut and dry answer for that. So for the sake of this video, I'm just going to use the average salary right now in the USA. So after a quick Google search, we can see that the average household income in the United States is $66,622. Why, yes, I know some of us are going to be looking for a household income quite a bit higher than that figure, and others might be okay with a lower household income. For the sake of this video, we are going to be looking at what it would take to earn $66,622 every single year in dividends. So to start out, let's go through a popular dividend ETF. We are going to be taking a look at the Schwab US Dividend Equity ETF, or SCHD. This is a rather large ETF. They have total assets right around $70 billion, a low expense ratio of 0.06%, which is great, and a dividend yield at 3.53%. That's a pretty decent dividend yield, especially if we compare it to SPY, which is paying out only 1.21%. So, overall, this is a great ETF. I know it's a very popular one in the dividend community. Looking over the performance of SCHD, you can see the share price has gone up 54% over the last 5 years and is up about 9% over the last year, which is coming in, a little bit lower than S&P 500, which I think is up about 14% over that same time frame. Let's look at that really quick. 15.62% over the last year. So you're not getting quite as good of a return on your share price, but you are getting a higher dividend to offset that difference there. So dividend yield, what exactly is the dividend yield? So the dividend yield is a financial metric that shows the percentage return a company pays in dividends relative to its stock price. So it will let investors know exactly how much income they can expect to earn from a dividend for every dollar invested in the stock. So moving over here to my dividend breakdown, we are going to look at SCHD, and they have a dividend yield of 3.53%. So for dividend yield, you can think of it like this. For every $100 that you are investing, you are going to get that much paid out to you over the course of a year. So you have $100 invested, the dividend yield is 3.53%, meaning that you are going to get paid out $3.53 for every $100 that you have invested. So if we change this target income to the national average, let's see, what was that? $66,622. You can see here that you are going to need to have $1.8 million invested in SCHD in order to reach your desired target income of $66,000. So I know many of you are thinking, I've seen some individual stocks that have a much higher dividend yield than 3.53%. So let's go take a look at why that might, why yes, these stocks do exist, such as Verizon here, that pays out 6.26% each year. That's not always a great sign. So first off, let's go plug that in. Let's see, Verizon, the target income of $66,622 and a dividend yield of, was it 6.26? Let me just double check that really quick. 6.26, yep. All right, so we can see that if you had a little over $1 million invested in Verizon, you would be getting the exact same outcome. So, it sounds great. Why isn't everyone just investing in these super high yield individual stocks? It takes a lot less to get more, or so it seems. If we look a little bit deeper into Verizon's stock over the same time frame, we can see that Verizon over the last 5 years is down 24%. In the last year, it's about the same, but if you had invested here, you would have lost about 24% of the money that you had put into Verizon. Looking through their dividends, you can see that their dividends have been increasing each year, but the actual dividend growth is actually decreasing down to 1.88% growth versus about 2.21% growth over the last, how many years is that? 8 or 9 years. A steady decrease in dividend growth, like we're seeing with Verizon, is never a good sign. A slowdown or decline in dividend growth can often signal potential problems with a company's financial health or future prospects. It is also a sign of a potential dividend cut coming in the future, similar to the one that we saw in AT&T back in 2022. Looking at AT&T, you can see that they were pretty similar to Verizon. They were, steadily increasing their dividend, albeit slightly year after year, until 2022, where they actually had to slash their dividend by 46%, and have since then been paying out the same dividend with zero dividend growth, just 27 cents per quarter since 2022. Now, another ETF that I would like to cover in this video, and one that I think has a lot of interest in the dividend community, is JEPQ. Now, this ETF is not like a traditional dividend focused ETF. Instead, JEPQ generates additional income through covered call options, making it fundamentally different. JEPQ earns income by selling covered call options on NASDAQ stocks such as Microsoft, Apple, and Nvidia. They then collect that premium and then pay out that premium as part of that monthly dividend that is paid out to shareholders. So looking through this ETF, you can see they do have a quite high dividend yield of 10.07%. One thing that is also different is you can see their dividend payout is kind of all over the place. Like some months you're getting 34 cents, while other months you'll be getting up to 68 cents a share. So kind of all over the place there. Also, the dividend growth, is actually pretty impressive, up to 31%. This is a newer fund though, so there's not a ton of history to go off of. We haven't really seen how this fund is going to perform in a downturn in the market. We might actually get that answer here over the next few months, depending on what the market does. So what are the risk and growth potential with JEPQ? So one of the risks with JEPQ is there's limited upside. So selling covered calls caps potential gains. So if the stock market does go up a ton, JEPQ is going to have those covered calls out, and they are not going to see that full return that they would if they were just holding individual stocks like other dividend funds do. Let's go plug this into my spreadsheet here and compare it to SCHD just for fun here. So we are going to be looking at JEPQ. Their dividend yield, it was right around 10%. So as you can see here, that looks really impressive. You know, to get our desired target income of $66,622, you'd only need $666,000 versus, you know, 1.8 million with SCHD. So this is definitely an interesting one. It's one that I have been looking into a little bit more as of recently, and it's one that, you know, I keep my eye on as well. Looking at how the payment is actually broken up within JEPQ, you can see that only 1% of the payout comes from dividends, and then the remainder is actually from your options premiums that you're getting from the covered calls that JEPQ is selling. Since so much of the payment that you are receiving as a shareholder in JEPQ comes from option premiums, that does mean that it does not qualify as a qualified dividend, and that this would actually be classified as an ordinary dividend. So what exactly does that mean? This is actually something really important, and that I don't know if a lot of people understand with dividends. So there's two types of dividend payments as they come through. You can either have a qualified dividend or an ordinary dividend. So let's get into exactly what is a qualified dividend. A qualified dividend is something that is classified by three main points. So in order for a dividend to qualify, it needs to be paid out by a U.S. corporation. So that's pretty easy. It needs to actually be a dividend. So it can't be that options premium that we're seeing with JEPQ. And then you also have to hold this position for a certain amount of time. For the most part, it's classified as holding it for 60 days during the 121-day period that began 60 days before the X dividend date. So for the example, if you had Ford shares paid as a dividend on September 1st, and the ex-dividend date was July 20th, you would need to have owned your shares for at least 61 days between March 21st and September 19th. So basically what they're doing here is they're making it so you can't buy in the day before the dividend payout is secured and then sell out, after you receive the dividend and make a quick profit there. So you actually have to be in these positions for a longer period of time. So why does this all matter? So looking at the actual tax rate for qualified dividends, as you can see on that first line here, you actually pay 0% in taxes on the first $47,000 that you would receive if you're single, and $94,000 if you are married filing jointly. So if you are actually in JEPQ and you are hoping to get that, that is not the case, and you will be paying based on your federal income tax brackets. So if you were to get the same amount, let's say you got $47,000 in dividends from JEPQ, you would be paying out in that tax bracket, which is 22%. So that is actually a very big difference, and it's something that you need to keep in mind as you are looking for what dividend stock or ETF you want to put your money into. So back to the question, how much money do you actually need to live off of your dividends? It's still, it's different for everyone. I'd say shoot for $1 million plus. You're going to need at least $1 million to get a meaningful amount of dividends from a safe dividend paying ETF like SCHD. With all that being said though, is a dividend investing strategy really the best fit for you? It also depends. For me personally, I'm 27 years old, and for my investment portfolio, I have gone 100% into volatile, high growth companies like AMD, like HIMS, like Celsius, these companies that don't pay any dividend at all, but can see a much greater return on stock appreciation, though it is much more volatile. As we're seeing right now, they are all down quite a bit more than the S&P 500 over the last few days. So take into account your investment timeline and as well as your risk tolerance in the stock market. If you are someone that is older or nearing retirement, obviously you're going to want to put the majority of your money into safer assets, or at least, an S&P 500 index fund or mutual fund. So for me personally, I'm looking to grow my portfolio as much as possible while I'm young, stay in these high risk, high reward stocks and companies. Obviously the companies I'm invested in, I have done research in and I am confident in moving forward. But if I was older, obviously I would not be banking as hard as I am with the majority of my current net worth in these companies. So that's all for this video. Thank you guys all for making it to the end. I really do appreciate all of you. I would definitely appreciate if you could like and subscribe. Liking this video helps this video get put out on YouTube to more viewers, and I would really appreciate that as it helps me. So thank you all, and I hope you all have a great day.